sky.
Welcome back to Give Me Some Truth. Happy New Year. We're going to start this with a discussion about the global macroeconomic environment, and that's why we bring Syl in. He's our resident expert that we have at Walkner Condon. I know, right? Right? Well, for all of those that are maybe uninitiated, every year we write an investment outlook piece, and it's really not to be predictive. It's more to take a look at some of the trends that are going on, taking a look also at what happened in the past, and then maybe form a little bit of an, I wouldn't call it an opinion, but more of an observation about what we may see in 2024 and beyond. So for a couple years now, Syl, you've written really the flagship piece on it, the global macro piece, as we like to call it. And, there are a bunch of different themes that I think we can dive into today. But first and foremost, how are you feeling overall about 2024?
I think I'm feeling pretty good right now, at least in the short term. I think, this time of the year is a good time to reflect a little bit on what we've been through in the last year. And I think it's interesting this year to think about where we were at the exact same time last year in 2023 and what the world looked like. And it was an interesting time. And you remember it. I remember it. But back then, the world was kind of ending. It was like everybody was talking about recession. There was a very strong consensus view that, we were entering a recession. And it wasn't even a question of if or even when. It was just how bad is it going to get, right?
Exactly where it was going.
Right. And I think it's interesting to reflect on it now, having actually lived through 2023. And look, it wasn't so bad, right? And I think it was part of what we wrote about last year in our 2023 outlook, was that there was this risk that investors were way too bearish and that there was too much of a consensus around this idea that, okay, everybody knows what's going to happen. It's just, going all in the same direction, and we should start to make drastic changes to our portfolio as a result of that, right? And I think it's interesting to take a moment to just reflect on that and see that, no matter how much noise and scary stories and headlines you read, sometimes there's not all of it is worth taking action, right? And I think a big part of what I wrote about last year was the fact that despite all the noise and the scary headlines, there were good things happening in the economy. And also that if you looked at central bank policy, even though, yes, they were raising rates aggressively, if you looked at it in a broader historical context, it wasn't that aggressive, right? Simply put, if inflation is 8% and you have 5% interest rates aren't that high if you think of them as, from an inflation-adjusted perspective, right?
We were over the conversation last year about
Yeah.
how it was almost accommodative.
It
because
was.
It was under the inflation rate.
Yeah. I mean, if you were to compare it to like the Volcker era, for example, it was extremely accommodative, right? And so I think we went from this starting point of early 23, where it was all about recession and the Fed was being way too aggressive, to where we are now when investors are a bit more constructive. And so it was kind of like, investor sentiments in 2023. It was like a block of ice, and it's been sitting in the sun for a little bit longer now, and it's starting to melt a little bit. It hasn't completely melted, but it's starting to melt a little bit, and that's where we are now. I still think there's a lot of negativity, but people are starting to realize that the economy is not in as bad a shape as we thought in 2023. So from that perspective, I'm feeling pretty good.
I kind of said last year I'd walk into your office, and I was a little bit more dour last year than you were, and walk into your office, and if I ever had to get kind of pumped up about the economy, I could go in and talk to Syl, because
Syl.
he was still always kind of a breath of fresh air, and you were fairly bullish last year when I would talk to you and just in your office, just in passing conversations. He would always say, the phrase, "I'm fairly constructive," which is what, somebody that is in the know says when they're feeling fairly bullish. I'm fairly constructive about the economy right now, and I always was struck by that. Last year, I was a lot more skeptical of how this was shaking out, and I remain kind of skeptical going into this year, and I do think that would be the general consensus amidst financial advisors in general and economists.
And I think you're right to be skeptical. And again, I feel pretty good in the short term, but I still think that, look, if anything, I think the chances of recession have actually increased this year compared to when we were last year. So it's like, from my perspective, at the start of last year, everybody was talking about recession. I didn't feel like the chances of recession were that high. Now there's, less noise about recession, but I do think recession chances have actually increased, not decreased. So even though I am constructive in the short term because there's a lot of good things happening, earnings are pretty strong, employment numbers are very strong. Data came out actually just this morning, surprised on the upside yet again. And inflation is coming down. Now, I think there are risks, and even though I have been bullish throughout the year, you're right, I've been sunny still. I am not. I'm bullish in the short term, but I have concerns about what's going to happen going forward. I think we're now in this environment where there's this expectation that the Fed is going to start cutting rate in the middle of the year, or maybe even as early as March. And, if you look at market implied probabilities of rate cuts, it's kind of scary in a way, because there's a non-zero probability based on those metrics that the Fed would cut rates something like 7 times, which is completely crazy to me anyway. And so to me, it's like, I can't imagine a scenario where the economy remains really strong. And, at the same time, the Federal Reserve starts cutting rates as aggressively as, futures market are predicting.
That would be a very, I would be very surprised if that were to occur as well, because that would be a major reversal of policy.
Yes.
In the Fed. I can't remember a time where they have done that, where they've aggressively cut rates in a strong economy.
No. Right? So to me, it's like one of two things is going to happen. Either those predictions have, some element of truth, and maybe it's going to go hand in hand with a weakening economy, or there's going to be some real disappointment in terms of, how much the Fed is actually going to cut. And I don't think either scenario is really good. So I am positive in the short term because I think we have a lot of very positive momentum going into the year. I think earnings are still really strong. I think employment numbers are still really strong. And I don't really see a catalyst in the short term for a reversal of this trend. But I may not be sunny still, throughout the entire year. And I'm already starting to see reasons to be concerned. And actually, I think in my outlook piece ends in the statement that 2024 could be incredibly exciting, but also very dangerous. And I think it's a good summary of my thoughts. Is I think we're in a very good market environment right now. It's kind of this ideal scenario of easier monetary policy, falling inflation, continued strength in the economy, continued growth in earnings. And I've even compared it to, like different eras of when the American economy was really strong. It almost looks like in some ways there are hints of what markets in the economy were like, in maybe the roaring 20s or the post-war boom or the bull markets that we had in the 90s. And it's all very exciting. But I also think that, periods of economic strength like those that we had in the past all had one thing in common, is eventually they ended in some sort of reversal, some sort of recession. And so, we can't get complacent and just assume that, things are just going to be good forever.
That's right. And I think that the main theme that we had of the investment piece that we wrote, we call it Back to the Future, and we harken back to a great series of movies. At least the first one was really good, and the other two, it's up for debate. But we're going back to some of these eras that we draw from in certain times, because what we were given, and you alluded to it a little in your piece too, right after 2008, we were told that this is a new normal and it was going to persist, and that was Muhammad El-Arian and Bill Gross really coined that phrase of new normal. And we're kind of going back to this era, I believe, of the old normal is the new normal again. And, we are going to see interest rates are going to be more of a normalized interest rate environment rather than something that's extremely low, unless we see a huge surprise to the downside. And, this consistent rate cutting and, mortgages in the sub 3 range, I think are just gone. And I don't know if we're ever going to see that again. And I just remember back when I got my first house in 2005, and my interest rate was, I think I started at like 6.5, maybe 6.75. And I refinanced. I was super happy because I got it down to 5.75%. I thought I got a huge win. And, now my mortgage rate is locked in at, I think it's like 3.125 for a 25-year mortgage. It's insane.
It's awesome.
Yeah, it's awesome.
And there's millions of Americans just like you. They have mortgages at 3%. It means that you're making more on your savings account at your local bank than you're paying on your mortgage. How awesome is that? You're getting paid 5% and you're paying 3% on your mortgage. What more do you want?
Unless you're a person looking for a new home right now and you're feeling a little worse, right? But yeah.
But that's part of it, right? I think one feature of the old normal, the new normal, as it's been called, which was this era of really low growth post great financial crisis, when it was like interest rates were going to be low forever, and it was just going to be QE infinity, and we just kind of had to live with it. It was low growth, low interest rate, low inflation. One of the issues that we had is that you couldn't get returns on your savings, right? And it was unfair to, in particular, to small day-to-day savers, like not wealthy people, but people who are just trying to save in their bank accounts, right? And they've been punished. Now we're back to this old normal environment where it costs a lot to borrow. And, if you save, then you should be rewarded. And, that's kind of the way that the economy was always supposed to work, right? We were never supposed to have free money for everyone, right? And I think, it's a positive thing to actually be going back to a more normal environment. And, this is the point that I make in my piece is, look, I mean, if I told you that 5 years ago that the real interest rates, real growth would be 5%, the interest rates would be 4.5%, and that we'd have 3% unemployment, you would have said, great, I'll take it. But it's
like, this is a boom time.
This is boom time, exactly. And you probably would have said, well, this is not really realistic because we're in this new normal, right? But yet this is what we have. So it's kind of, why are we complaining so much?
Yeah, I wrote that in my piece, kind of about, all right, some of these economic indicators have gotten a little worse, but only a little bit. And oftentimes when we look at, say, retail sales, okay, they've perked up. They went down a little bit and they perked back up. And the manufacturing hires went down a little bit, but it's not too bad. And so we're all feeling this crisis of confidence, I think. When you look at the consumer confidence numbers, they're actually quite weak. And then you look at all the economic data and it doesn't match up. So, that's meaning, who's right and who's wrong there. I'm not sure. I do believe that there is a hangover effect from pricing. Everyone's seen everything get more expensive, and just go out to lunch and you see it right there in your face. Right. There is no, $8 lunch anymore. It doesn't exist. I think I spent $15 at Chipotle the other day, and I was like, holy cow. Like, it's pretty insane.
You always get the guac, though.
I do, a little extra protein there. But, it's one of those situations where I do believe that people are feeling that, and I think that does have a negative consequence for consumer confidence. But you look at their net worth, and their net worth probably has never been higher either.
Mm-hmm.
So, there's some things that I think you just got to look underneath the surface and appreciate some of the things that have happened. And we've never had a COVID, in most of our lifetimes. There have been other pandemics, obviously, but how we handled that is definitely a new situation, and I think we saw the ramifications from that. And I also have said in the past, too, that the Fed has never had this much access to data as quickly as possible as they ever have now. And so when they're trying to engineer the soft landing, and I always joke, like, this will be the first time they ever engineer a soft landing, and I kind of roll my eyes every time when I think about whether or not this is doable. But maybe the data that they have is allowing them to be more nimble. And they've been, one thing that I've always said after Greenspan kind of started it, the Fed has been really intentional in their language, and what they say they do, they have done. And, yes, we all parse the words and the statements they make, but they have been extremely intentional from Greenspan all the way down to Powell now.
Yeah, I think the transparency and the guidance really helps. I do think a lot of what we're seeing now in terms of the positive developments in the economy, I don't think that the Fed can take credit for it.
No.
I'd like to give the credit to, workers and businesses that, have just done a great job, and, innovation is really helping. And, the monetary policy has allowed all of that to happen.
Or it hasn't screwed it up.
It hasn't screwed it up. And that's kind of my issue with, the environment as a whole, is we're still in this environment where we're relying on central bank policies way too much. And even though I've been pretty positive in this podcast and I've been bullish throughout the year, we're still not in a normal environment, even though interest rates have been normalized and the economy is looking strong right now. If you look at metrics like the size of the Federal Reserve's balance sheet, it's still incredibly inflated. We're still in this environment where, they've responded to the collapse of SVB last year with a bunch of temporary liquidity measures. And even though the trend in the US is that they intend to tighten policy and shrink the size of their balance sheet, if you look at it on a global level, and if you look at things like what the People's Bank of China is doing, or the Japanese central bank, they're moving in the other direction, and they're actually expanding their balance sheet. So if you look in aggregate, we're still in this environment where global central bank policies are a risk because they continue to inject liquidity. And I think that's one of the key risks that investors are facing right now is that we are inflating asset prices because of central bank policies, and that's dangerous because that could be reversed quickly. That could lead to asset bubbles, and I think investor sentiments that have been fairly negative and bearish actually have done a good job at keeping valuations in check. But going forward, I think that's a real risk, and I think we're already seeing pockets of kind of maybe excessive enthusiasm, from investors in some pockets of the market, some areas of the market. I still think there are other assets that are cheap and really attractive, so that makes me fairly constructive on the market as a whole. But at the same time, I think we have to be very mindful of what's going to happen here in the coming months.
Yeah, I mean, what happened last year, it was kind of harkens me back to when the internet age first started, and if you had a .com after your name, your stock valuation went up, tenfold just because you had that in your name. And now if you're tied to AI at all,
Exactly.
similar deal.
So AI is kind of, you can justify any valuation using AI. That's a risk going forward, right? And we've seen market bubbles, and it starts with some sort of story that sounds great and can, justify anything. And obviously the internet bubble of the late 90s was an extreme case. The good thing now is that, unlike the 90s, the companies that are trading at really high valuations right now are actually making money. They actually have sales. They're very successful businesses.
They're large caps. Yeah,
they're large caps,
different,
right? So from that perspective, it is fundamentally different. But again, it doesn't mean that valuations can't get, completely out of whack with reality. And if you compare the size of these tech mega cap relative to like the GDP, for example, if you look at that chart, at that metric, it's a little scary, right? If you like compare the size of those large mega cap tech companies now relative to GDP, it doesn't look sustainable. So, that's a risk that investors need to be very, very mindful of. But again, short-term momentum, I think there's a lot of good stuff happening, and I could absolutely see this trend continuing, especially with, the whole AI narrative as it takes hold. And if it's backed by continued earnings growth, I think this rally probably has legs.
So if we look at kind of sectors and asset classes overall, what are your thoughts really on, one issue that I have right now with the S&P 500 is that it is so overweight in tech. You're almost owning a quasi-tech sector fund if you look at it. The concentration is so great in the S&P 500 in technology. How do you defense against that without making some outsized bet or really reworking your portfolio where it might be problematic for you?
Yeah, I mean, it's tricky, and you're right. I mean, if you look at the sector breakdown of the S&P 500 right now, it's really dominated by, you really own growth and you own technology and communication services. And you're probably not getting as much diversification as you would think. You're not getting as much in the way of, boring dividend-paying stocks. You're not getting a lot of stocks that are trading at cheaper valuations. And, there are ways to, diversify away from that. It might require going a little bit deeper than just buying the index and, look at things like sector-specific funds, look at things like international diversification as well. That could be a way of naturally shifting some of your capital away from the sort of hot sectors and into things that are cheaper and, not as trendy right now. And I think it's part of the work that we're trying to do with our portfolios is looking at the index and saying, okay, what do I actually own? Is there a need to take steps to diversify further? And I think that's something we always need to be aware of, because the way indices work is you're basically following a trend. If a market cap grows, then that becomes an increasingly large part of your portfolio. And it can happen with the S&P 500. It also happens with things like emerging market funds. At some point people realize, I own these emerging market funds and it's 40% China. So it's kind of like I think it's something that you need to be very aware of, and I think there are ways to mitigate against that concentration risk, but it might require that you do a little bit more than just buy the index.
Yeah, I agree with that, and I tend to think that some of the dull, boring, and consistent companies, might kind of see that day in the sun again this year. I mean, the breadth of the rally kind of began late in the year. It was a very thin rally. everyone's called like the Magnificent Seven or the Great Eight stocks, and they were contributing to a large percentage of the rate of return in the S&P 500 and just in the overall stock market. And, then kind of November, December happened, and it kind of righted the ship a little bit. We saw international funds do well. We also saw that it became a broader rally. And so I think that that's where you're starting to see that consumer sentiment also kind of turned a little bit at that time too. Things were ticking up. Retail sales were ticking up. You could see that there was some momentum coming into this year. So we all should probably be extremely bearish as well going into the year, because Jim Cramer just announced that he's very bullish, and Jeremy Siegel came out too, very bullish for this year. So we should be a little careful about what we believe going forward. But I say that all tongue in cheek, but it does seem like more people are coming out as bullish as going into this year. So that automatically makes me a little bit skeptical. But overall, I tend to agree with you. And I do think that, last year, asset allocation didn't really work,
Yeah.
And this year I tend to think that we'll probably see, whether the market trends down or up, I do believe that asset allocation will be a constructive thing for your portfolio this year, rather than riding those 7 or 8 stocks again, or riding just an S&P 500 fund. I really believe that we need that diversification in our portfolio. The sun is going to shine on other places this year, and hopefully it's more positive than negative, but even if it's negative, you do need that diversification in your portfolio. And bonds are sexy again. You're getting some yield.
I agree, and it's been a difficult couple of years for investors, also in part because you're supposed to hold bonds for diversification, and it's supposed to be something that does well when the market sells off. And obviously we had all-time highs at the very end of 2021, beginning of 2022, and ever since, the market has generally been down, and bonds have just been terrible, right? And that's usually when you start hearing things like, oh, bonds are dead, or they don't belong in a portfolio, or whatever, or the 60-40 is dead, and you should no longer allocate to bonds. And I don't really agree with that. I still think that there are very valid reasons why you would want to own bonds. We've just not, it's just not going to work all the time, and we've just not been in the right type of environment. But I do think that bonds are back, as you said. We've gone through a decade when interest rates were, you were buying the 10-year treasury at 1.5%. Now you're looking at it and it's over 4%, and I think it starts to make sense again, and it's kind of an easier sell. So I actually like that going forward. I think there's an opportunity certainly to look at bonds and reassess, how they fit within your portfolio. And again, everybody's going to hate bonds, and then there might still be like environments when you'll be glad to own bonds, right? I mean, we've lived through 2008. Bonds were the only thing that was working, and not just bonds, but the most boring, safest bonds that you could own, U.S. Treasuries. And, hopefully we'll never see a 2008 again in our lifetime. Am I willing to bet on that? Yeah, no, I'm not.
Oh, we'll see it again. We'll see it again. It'll just have a different name. And all history just likes to rhyme, right?
Exactly.
It's all the unforeseen. And I just read a book that they had a great quote in there. They just talked about the stock market and how every company is just basically a good story away from a higher stock price, and conversely, a bad story. It's about how good companies can tell their story. Mm-hmm. And in a lot of cases, that can be the catalyst. And right now the story is AI. Yeah. The story is continued growth, and we'll see whether that continues to persist. Hopefully we don't end up in Skynet and we have to all watch. Maybe the theme next year will be Terminator 2, but hopefully not. We'll see some guardrails around AI, I think, at some point here coming soon. And, we've got a lot of interesting things going on right now. And I think the one constant that we have in the markets is that it always seems a little bit unsettled. And it always seems, you never feel like you're in a big bull market when you're in the bull market. And you see this skepticism, and I think all that's healthy, though.
I agree. I mean, the picture should always be, mixed and complicated and confusing. I mean, that's the way it should be. And we have discussions with investors who, find reasons not to be in the market or to keep more cash. And look, you shouldn't feel good about investing. That's the reality, right? I mean, and if you ever invest and you're like, I feel so great about it, nothing could go wrong, is you may not be buying at the best time. That's usually when people buy, and they buy the peak of the absolute bubble when nothing can go wrong, right? So looking at the environment, there should always be positives and negatives and areas that you're concerned about, and that's what makes a market, right? So it's all part of it, and that's the way it will always feel, hopefully.
I think that's a great way to say that. Well, going forward, I would say, hey, dive into our investment outlook. We will have it on PDF. We have a bunch of links on it as well, where you can go and really explore as much as you want. And basically what we try to do as a company is that everyone wrote an article and had their own view. So not every view will be the same. We don't we don't mandate that anyone come up with any ideas. So you might see some divergent opinions there. You'll see everyone writing kind of along the theme of Back to the Future, which is kind of a fun thing we tried to do this year, and you'll let us know your feedback. And we'll be recording more podcasts as we go along. As far as each topic goes, we'll split them up into blog posts as well, and write and reflect more as the year goes on the writings. But if you read one piece from us, please take a moment to read our investment outlook piece. Special thanks to Samuel for putting it together. He's put together some great graphics that we're really excited about. And if you have any comments or questions, please don't hesitate to reach out. And we look forward to serving you and getting to know you a little better over more episodes of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.
You gotta leave your money behind you. Raise your hand to the sky. Ask the masses for silence.